And second presentation, unfortunately, he could not come, but we can broadcast his presentation, Professor Paul Smoke, New York University. Okay, so can you start the video presentation?
The basic outline is I'm going to just say a few words about what the issue is and why it seems to have become more important. A few words about the landscape of subnational development finance, and then I'm going to focus a bit more, given the limited time, on the idea of a strategic approach to enhancing subnational development finance. A few words about selected experiences in the Asia region with subnational government financial intermediaries, and then a few concluding thoughts. So there has been a lot of attention recently to subnational government investment and development finance in emerging economies. And I think a lot of it, of course, has to do with the large infrastructure gaps in an urbanizing world and some of the global development agendas like the Sustainable Development Goals and the Associated Financing for Development initiative. Subnational government share of total public investment, and this is from a sample of 90 countries of all income levels that was considered by the OECD, averages 39.1%, and it ranges from 49.1% in high income countries to 7.3% in low income. And so the role in low income countries is fairly constrained. And one of the big issues then is it feasible to improve this role? There's also a series of challenges: weak domestic capital markets and poor subnational government creditworthiness. And we have intergovernmental frameworks that don't sufficiently empower subnational governments. If we look at that same OECD study, the subnational government share of public spending in high-income countries is 29.7% and 7.3% in low-income countries. There's a particular constraint on the revenue side, not enough access to own source revenues, they're not used well, problems with fiscal transfers. And one of the problems that I think is really important is that a lot of intergovernmental fiscal reforms are fragmented and based on unrealistic expectations. You have people who are trying to promote municipal bonds or develop a particular financial instrument, but sometimes I think there's not enough attention paid to the larger set of reforms and options. So in terms of the landscape of subnational government development finance, I think we know that the main instruments are intergovernmental transfers and various forms of loans, bonds, commercial banks, and special financial intermediaries. In a lot of emerging economies, transfers are the story and bonds are very rare, and these special financial intermediaries play varying roles. But most subnational government lending in lower income countries certainly is done through special financial intermediaries, and there's often been a lot of problems with them. Some people have also been promoting public-private partnerships as a solution for enhancing subnational government development finance. These are often problematic. I talk about them in the paper, but I'm not going to have time to talk about them here. One of the other issues is recurrent revenue and financial management. So obviously, even though I'm talking about subnational development finance, the underlying recurrent financial system and the financial management system are essential for any possibility of access to long-term development finance. So there's a lot of issues with intergovernmental transfers in emerging economies, and there have been some successful revenue reforms in a number of places, but honestly, really not what people would expect. There have been some recent innovations that are relevant for borrowing, such as land value capture to raise funds from land value increments generated by infrastructure. So examples include things like betterment levies, land readjustment, special assessment, tax increment financing, and so forth. So there's some promise on that front, but they're not being very widely used yet. And then, of course, basic financial management and asset management are going to be really critical to borrowing. So in terms of debt, debt averages 9% of total public debt. That is, subnational debt averages 9% of total public debt in that OECD sample, but it's effectively zero in many developing countries. It's larger in federal countries because of the role of states, but in non-OECD countries, it's actually quite small except for India. The stock of subnational government debt on average is 57% loans. Bonds are used more in federal countries, but not so much in unitary countries. And again, the bottom line is that loans from other sources, primarily the central government and special intermediaries, account for over 60%, and they really are the sometimes the only source in developing countries. So the issue of markets versus special entities, well, it's hard for local governments in many emerging economies to access capital markets directly. So these special intermediaries like municipal and regional development banks and funds are important. Now, these have been around for a long time, but they really haven't worked that well. There's been poor repayment. A lot of them, which were funded by donors, failed to establish revolving funds, and a lot of donors pulled out of the early versions of these funds. So some of the things that accounted for this poor performance was a lot of heavy public sector control. Many of the early ones were based in or attached directly to ministries of finance. People argued that this weakened managerial incentives, and there was a lot of politicization of lending decisions. They also tended not to use proper credit rating and project appraisal mechanisms, so you ended up with a lot of bad loans. And interest rates were often more heavily subsidized than necessary and often not on clearly justified terms. Now, a lot of these entities were capitalized by loans from international development and financial institutions, which is fine, except that in the end, some of these institutions only cared about being paid back and weren't that much worried about whether the local governments that took the loans had paid them back to the central government, as long as the central government paid back the loans. Some of the other challenges were that a lot of these special entities became, in effect, monopolies. They just dominated every aspect of subnational lending. They helped local governments prepare projects. They gave them technical assistance. They were involved in evaluations of the projects and so forth. And so you had some conflicts of interest embedded in these institutions. And there was the actual attempts to enforce repayment were pretty poor, and this just ended up further hurting subnational government fiscal viability and creditworthiness. Capacity was often an issue, but capacity in many cases just reinforced the politics and the nature of the complex intergovernmental relations. Some of the lessons we can take away from these experiences are that the more successful of these subnational government credit institutions tended to have larger roles for the private sector, both in management and funding. And in some cases, they were strategically planned to grow over time. And the more successful ones really focused on lending. They didn't really get too much into the common heavy level of involvement in the various project functions, the aspects of the project cycle that I talked about before. So what does all this tell us about how we might think strategically about approaching subnational government development finance? Well, I think it's fair to say that emerging economies are going to need transfers and special financial intermediaries. There's a more limited scope for bonds. That these various financial intermediaries can take multiple forms: dedicated accounts in national ministries, separate legal entities. Some of them are fully controlled by the government. Others have varying mixes of public and private control, and the sources of finance for the various options will often. So where there is sufficient potential for subnational government access to capital markets, of course, this option should be developed. But more typically, these financial intermediaries are going to be needed, and the blend between public and private roles is going to depend on various factors. The degree of subsidy involved, how governments feel about private involvement, and private sector interest in being involved in such an entity. So this doesn't mean necessarily that something has to stay static. In a number of countries, these institutions have evolved. So the process starts with a dedicated account in the Ministry of Finance, and it just on-lends donor funds and in some cases national budget funds to subnational governments. Then you could think about moving to a separate legal entity that's initially under heavier central government control, and then ultimately you diversify the sources of capital. And at some point you end up with something that is much more heavily managed by the private sector. Now, of course, these kinds of institutions aren't going to be enough. You're often going to require risk mitigation strategies, and there have been lots of instances of full or partial credit guarantees, secondary market support, co-financing, bond banks, credit pooling, and the use of risk instruments offered by the insurance industry. I'm not going to talk about any of these, but they are critical to making these arrangements work. Now, a second thing, in addition to the variance in the institutional options, you need an array of financing arrangements for different types of local governments and projects. So private sector mechanisms and a borrowing framework for creditworthy subnational governments and self-financing public investments. Let them go to the market if they can. Semi-public mechanisms for less creditworthy subnational governments and perhaps projects that can't fully recover costs and need a bit of a boost. And then on the other end of the spectrum, intergovernmental transfers and special types of funds for the poorest subnational governments and basic services that target national objectives. So the basic idea here is to make sure that fiscally strong local governments would not be eligible to receive grants for self-financing infrastructure projects, which could be better used for other purposes. And you want to generate incentives for weaker subnational governments to improve their capacity and try to modify their behavior so that they can begin to borrow for infrastructure investments and ultimately more and more on that front. So the expectation is that over time, more subnational governments will become creditworthy. More projects will be classified as at least partially revenue generating. And subnational governments can move across these categories and use different types of finance mechanisms. Now, of course, the trick is if you start at a particular point, how do you get weaker subnational governments to graduate from full reliance on grants and highly subsidized loans? And some of this is just going to occur as growth occurs, as there are institutional reforms and changes in political dynamics. But in most cases, you're going to need a proactive central government policy to help promote these changes. The way that the central government offers regulations, systems and procedures, incentives, technical assistance in capacity building, and so forth. Now, one idea might be to, for local governments that can't go to the market and that want money from a central government or a special credit agency, to create a more explicit linkage between grants and loans. So if they want public money or money from one of these institutions that have some public involvement, there would have to be a standard application process. And then the project would be evaluated on the basis of standard rules its bankability, but there could also be a determination that it's a worthwhile project, but loans are out, or you need to have a combination of grants and loans in order to make the project viable. And of course, you'd have to have, I talk about this more in the paper, I'm not going to have time to do it here. There are going to have to be rules that ensure efficient and fair use of the funds. So there's going to have to be things that relate to the cost efficiency of particular projects, the way tariffs are set, how the interest rates would be set for certain types of projects, and affordability standards. But the basic idea would be that if in repaying the loan, allowable annual outlays based on the cost effectiveness standards plus debt service for a long-term loan at the prevailing interest rate exceeds maximum annual proceeds from user charges meeting specified standards, including affordability standards, the subnational government would be subsidized. And so this is, this is a very tricky thing to do. It can be, there would be a lot of challenges involved in framing such a process, but I think it merits some type of consideration, because the potential benefits, I think, of doing this, I think that it may get us around some of the problems that we see in the current way that subnational government investments are financed. A standardized process should limit the possibility for wealthier subnational governments to be subsidized. The objective appraisal is going to improve project selection. You won't have as much of the bad project problem. Even a small loan element for a poor local government will begin to improve financial discipline for these fiscally weaker subnational governments, and perhaps start them on some kind of a path to better creditworthiness. And the closer to market rates on loans is going to force the subnational governments to consider capital costs more fully, and the various kinds of standards can improve operational efficiency, cost recovery, and targeting of the needy local governments through the affordability provisions. Now, there are elements of all of these in the way that decisions are made about how to get development finance to subnational governments in many countries, but they're really not very systematic. I'm running out of time, but I wanted to say just a few things about a few examples of how these intermediaries have been used in Asia. So in India, the municipal corporations, and a number of them have issued municipal bonds. But the interesting thing for me in India is some of the states that have innovative entities for subnational government lending. And one of the famous ones is the Tamil Nadu Urban Development Fund, which is managed by a public limited liability company with equity participation from Tamil Nadu, the state, and a range of private financial institutions. So it uses pooling mechanisms. It can offer grants, although not along the lines of the grant-loan linkage that I just talked about. It's a much more informal kind of grant contribution. And they can also intercept transfers if subnational governments don't pay back the loans. So there have been some positive developments. A lot of other places have built on the Tamil Nadu experience. The Philippines has not really borrowing by subnational governments, by municipalities anyway, but it has a range of financial intermediaries. So there's a municipal development fund in the Ministry of Finance, which is mostly financed by loans from international financial institutions. It's on lent to the local governments, and they can also give a mixture of grants and loans. But again, the process for determining the grant component is very simple. It doesn't have very much sophistication to get at some of the differences in projects and local governments. And there's also, this is one of several, but the Local Government Unit Guarantee Corporation is a private entity, and the Development Bank of the Philippines is a major shareholder, but it provides loan guarantees to subnational governments that meet eligibility requirements. Indonesia's had a pretty bad history of subnational government lending. Most of the mechanisms, again, mostly resources on lent from international financial institutions, have been through special accounts set up in the Ministry of Finance, and they haven't performed very well. So Indonesia is now creating something they call the Regional Infrastructure Development Fund, which is to be operated by a state-owned enterprise. So it's at least moving out of the Ministry of Finance. And the capitalization is going to be a mixture of IFI loans and a government equity contribution, with the MOF assuming the exchange risk. So they've really gone a long way towards well-defined lending and assessment criteria, and they've also changed the regulatory framework at the national level quite a bit. They do have a project development facility that's associated with it, but it's separately managed, so you're not commingling the lending decisions and the other aspects of project development. So in terms of comparing these cases, it's a small number of cases. I've only told you a few snippets of facts about them, but I would say that the mechanisms differ, but the entities that have been successful in the new designs are broadly consistent with some of the lessons from international experience that I talked about earlier. They're generally moving beyond the errors in their past systems. There's broader management of the entities. There's more private involvement, except in the Cambodia case. There's robust criteria for proposals, assessments, allocations. And if they're offering technical assistance for project development, it's through separate mechanisms. And a few of them link grants and loans, although again, not in the way that I was recommending in the earlier comments. So finally, just a few concluding observations. There's a lot that can be done in this area to improve on the lack of subnational investment and ways to finance it. The pervasive lack of creditworthiness is limiting some of the options that some analysts might like, but there are opportunities. And I think one of the big lessons is that countries are different, and although you need sound principles, there have to be approaches that are individually tailored to each country. And the problem is that to make progress over whatever your starting point is, that you can't just be simply developing improved subnational credit mechanisms. You have to have reforms in the overarching intergovernmental fiscal frameworks, which includes the transfer system, the own source revenue system, the regulatory system, and these things are also essential if there's going to be movement in this area. Again, I've said this before, but the bottom line, I think, is that creditworthy subnational governments should have access to capital markets if they're appropriately regulated. They should not receive grants or subsidized loans for self-financing projects, which happens in more countries than we would like to believe. Less creditworthy subnational governments are going to need these other options, so some mix of these financial intermediaries is going to be important. The fiscally weakest local governments are going to continue to depend on grants, but with the type of a process I mentioned before, I think that there are ways that you can pull them out of that trap and help them to develop the capacity for initially borrowing, even at just a very limited way. And finally, it's important to remember that how these subnational government financial intermediaries are structured and operated matters a lot. Who owns them? Who manages them? Where does the finance come from? The lending policies, are they meeting proper standards? All of these things, you've seen progress, but I think there's room for a lot more work in this area. And finally, just a closing note that there are a variety of other mechanisms I think that can be used to help support subnational governments to be able to perform better. Things like performance-based financing, performance-based grants, which I talk about in the paper, project preparation facilities. There's a little bit more detail about in the paper. The government really needs to play a proactive role to make this work. So I've given you a whirlwind tour of a lot of things. I probably tried to cover too much, but I hope I've at least given you a few thoughts that will give you some things to talk about. And I'd appreciate any feedback that people have about how to develop this further. I think there's a lot more work that needs to be done in this area. Thank you very much.